Welcome back to Real Estate Economics Weekly Webinar Series. This week we're covering product screening and identification for land acquisition opportunities, and we're using Clovis, California as our case study area for today. This is part 3 of 3, so we've already considered the resale market and the new home market. Now we're going to take these two bodies of information and consider how do we use this information and this market research to our market advantage. First, we're going to target the market positions that we've identified as having the highest sales potential and the most potent demand. Second, we've analyzed which price points, room counts, and unit size ranges are underserved. Then we're going to overweight those particular market positions in terms of number of plans. We're going to concentrate the plans into the most potent demand area, that recognizing that we can adjust the unit mix over time. We're going to make sure our market coverage includes price, size, and especially buyer profile. We're also going to consider if we have any plans that aren't perfect, or we want to cover a real bread and butter price range, for example, but we don't have that great of market opportunity. We're going to use room counts, garage configurations, and different options that will help our plan compete and help it move with the market over time. Last, we recognize that our competitors are going to view all the successful floor plans and communities in the market area. So what we want to do is establish a price structure and use designs that are durable and won't be easily compromised or outflanked over time. The last thing we'd like to do here is establish a high-selling floor plan and immediately start raising the price in it and compromise our price advantage. What we'd like to do is maintain that advantage and spread some of the absorption off to larger or smaller floor plans. Sometimes it's helpful to look at this on a conceptual basis and plot the market comparables and price lines and then see where there's opportunities. So what we've done here is we've made a visual presentation of this using one of our online products, the competitive floor plan comparison. I've added the arrows just to show spots in the market where there's a unit size gap or a unit price gap, or better yet, both. Now clearly we can dig down from there and start to look much deeper and look at the surrounding floor plans and see, are they one-story plans? Do they have two-car, three-car garage? So we can fine-tune this to really an incredible degree, but initially, and for our purposes today, we're just looking for holes in the market that we think we can exploit. Now the blue diagonal line is the new home price line. That's the regression line that represents in a single line all those floor plans. So all of our pricing is to the right of that line, suggesting that we are going to underprice the current new home market. We've seen in the previous sections that the overall market is performing at about 2 to 2.5 sales per month per community. Would certainly like to do better than that. We also have cause to believe that there's some slow months ahead based on the tax credit expiring and general economic conditions. So we don't want to price at that existing new home price line right now. We believe that there's a good chance that's somewhat overstated, and to really capitalize on the underserved new home market, we need to get those prices down where the market's going to meet them soon. So from that last analysis, here's plotting of two separate floor plan configurations. The bottom one, let's just assume, is 4,000 square foot lots, and the larger line with the 4 dots is our 7,200 square foot lots. Again, we're showing plotted the new home price line in blue. This time I've added local resales from the Clovis market area for homes that were all built since year 2000. We would consider many of those homes to be generally contemporary, modern in their color schemes, generally modern in their designs. Of course, it doesn't reflect the latest in designs, but those homes are new enough and can be well enough maintained to present us with some competition. So what we've done, there are many less homes in the smaller, more affordable price ranges. So we've plotted our 4,000 square foot program up a little higher. It's above the resale price line and below the new home price line. For our larger program on our assumed 7,200 square foot lots, we've got that priced as low as the existing resale price line with a greater advantage in the higher price points. Now over time, the higher end of this market looks to be increasingly competitive. We think loan underwriting standards, increasing federal taxes, and some other government policies are going to reduce the amount of disposable income that many people can take home. It's going to slow their ability to accumulate a down payment. So in the higher price ranges, we recognize that in all markets we have fewer buyers, but particularly over the next 1 to 2 years, we think some of these higher price points may have still fewer buyers than they have historically. So we want to maintain a significant price advantage there. We'll take those two programs and run those through a very simple static land residual. Any participant in some of these market areas is going to know specifically their house costs and all of the appropriate inputs for construction, soft cost, sales and marketing, finance, and all the general categories, G&A, real estate taxes, builder margin. And then we can look at our land residuals and really fine-tune that and see how our market opportunities play out. I like to run this many times with a flat direct construction cost number, because what that will help us reveal is, are the lot residuals higher for the larger programs? If so, we know there's some upside in the larger units. In this particular case, the largest floor plan in the compact lots is a couple of thousand above the next largest program. But if you go down to the standard lots, the largest home produces a lower land residual. That probably shows us that there is weakening at the upper end of these price ranges, and it's not economical to build that largest house instead of the 2,500 square foot plan. Now obviously we'd expect some economies of scale in building the larger house, so we may want to run this with a staggered direct construction cost, lowering the cost into the larger houses, but we don't want to go in with a bias towards the larger home. We think that was a huge mistake in the last run-up, that a lot of programs were built to land residual instead of to realistic market conditions on the ground. So what's our summary here? You can use our tools, downloadable, no subscriptions, no discs, no books. Anyone can buy a one-off or evaluate a market area. You can dig into your local area in our housing transactions report on a city, on a state, on a zip code basis. If you know a specific master plan you're looking at, you can draw your own polygon and become very granular on that analysis in a real simple, straightforward way. You can do this in a detailed fashion if you choose, or a quick cursory deal screening way. If you like the deal screen, then you push ahead and you can consider all the aspects of what's taking place in that market, the features, the specifications, incentives. Use your own in-house floor plans, or you can do what we've done in today's case study. We've looked at the market, drilled down to see where there's market opportunities, and responded accordingly. Also, we've been able to use this data to avoid highly supplied price ranges, unit size ranges, and room counts. Really, our goal is to stack the deck in our favor and deliver to the market a program that has so many built-in positives that it will be very difficult to counteract or combat. Here's an overview of what we do at Real Estate Economics. Some of what you've seen today is our residential market consulting, site-specific feasibility studies. These are all using the tools we've presented today, which are available to anyone on our website, www.realestateeconomics.com. On a consulting basis, we do specific supply and demand analysis and also retainer services. We're always amazed at how much expensive land is purchased with a minimum of research. If you don't have people to do that, we're more than happy to handle any of that for you that you so desire. Online services is what we've been talking about today, our housing transaction reports. You saw our survey to survey and some of our new home statistics. Here's our team. In the top left is Mark. He's the principal and owner of Real Estate Economics. I'm John Mulville. If there's any questions about today's presentation, program, or our services, please call me at the number there. Judy's in our sales department. She's the one who can tell you about the subscriptions, and Sandy provides our customer support. Thank you for joining us today.